Welcome to the Sunday evening edition of Storm Stock Solutions. I'm Grant Mercer. We're heading into the last full week of trading for the year with a market that just took a punch from tech and AI heavyweights, but futures tonight are mostly flat. The tone right now, rotation, not panic. Let's bring some clarity to the chaos of what just happened and what's coming up. According to reporting from MarketWatch, U.S. stock futures are little changed tonight after stocks slid on Friday, led by a sharp decline in the tech sector, as investors kept pressing a rotation trade out of AI names. That's really the heartbeat of the week we just saw. After a massive run in anything AI-related, traders finally started asking, what else works? Where am I overexposed? Layered on top of that is a macro story that could matter a lot more than it sounds at first glance. Kevin Hassett, a former top economic advisor to Donald Trump, told MarketWatch that if he's ultimately chosen as the next Fed chair, the president would have no weight on the Fed's decision-making. Whether you believe that or not, the market hears potential change at the top of the Fed and immediately starts gaming out scenarios for interest rates, inflation, and volatility. Even the possibility of a new Fed regime can nudge risk appetite, especially after a long run in growth and AI names. Stepping back, another big theme highlighted by MarketWatch this weekend is that stocks risk a stir-up in this final trading push of the year. You've got a delayed November jobs report and a key inflation reading on deck. Two data points that can swing expectations around the Fed's path in early 2026. Add thinner holiday liquidity and year-end positioning, and you've got the recipe for bigger intraday swings than the calm futures screen tonight might suggest. Now, in a week where the indices were choppy and tech cracked, where did strength show up? Interestingly, some of the most popular stories weren't about hot ticker trades at all. They were about real-world balance sheets and cash flows. One widely read example from MarketWatch: a family wrestling with rental properties and a lawyer urging that their children still buy them out, even after paying rent for years. That piece has a bullish tone in the sense that it spotlights people leaning into real assets, long-term income streams, and intergenerational planning. Those are the kinds of themes that often underpin strength in sectors like real estate, regional banks, and dividend payers when traders cool on high-octane growth. On the flip side, the areas that look fragile right now are where policy risk and macro uncertainty intersect. The Hassett interview is a good example. The idea that the Fed might get a new chair, and the debate over how independent that chair would really be, keeps the spotlight on rate-sensitive corners of the market: regional banks, small caps, utilities, and parts of the housing complex. These are areas traders may handle with care until there's more clarity on the 2026 policy path. Let's talk about some sleepers, stories I'm watching in the background that could matter more if conditions line up. First, healthcare and insurers. As Jamie Lee reports at MarketWatch, Monday is the deadline to enroll in Affordable Care Act plans if you want coverage to start January 1st, and the subsidies that made those plans cheaper are expiring after 2025. That implies higher marketplace premiums in 2026 and potentially shifting demand dynamics for insurers, hospital systems, and healthcare providers. It's not a today trade, but it's exactly the kind of slow-burn policy change that analysts will be modeling into revenue and margin assumptions over the next year. Second, personal balance sheets and retirement decisions. Several of the weekend's most clicked stories were about couples in their 50s asking, where are we vulnerable? With paid-off mortgages and mid-six-figure IRAs, or about whether to file for Social Security at 67 versus 70, with income dropping to a fraction of prior salary. Another piece broke down how to check up on a financial advisor before you invest, and yet another featured a Walmart worker who slowly built up a $2 million nest egg over decades. These aren't stock tips, but they tell you a lot about sentiment. People are focused on risk management, income, and longevity. That backdrop tends to support interest in dividend strategies, bond funds, annuities, and other income-oriented products, even as the market debates growth versus value. So what should you watch as we head into Monday's open and the last full week of trading? First, whether this rotation out of AI and mega-cap tech deepens or stabilizes. Do we see follow-through selling in the high flyers, or does dip buying show up quickly? The answer will help determine whether this is a mild year-end reshuffle or the start of a bigger factor shift. Second, the macro calendar. The postponed November jobs report and that key inflation print are front and center. If the jobs data come in hotter than expected, traders may start pricing in fewer early 2026 rate cuts. A cooler number, especially paired with soft inflation, could calm nerves and support a Goldilocks narrative into year-end. Third, any additional headlines around the Fed, especially talk of future leadership or policy direction. Even comments that nothing will change can stir the pot because they remind markets that a change might be coming. And finally, keep an eye on liquidity and flows. This is the time of year when tax loss harvesting, window dressing, and thin volume can exaggerate moves both up and down. Sharp swings in individual names don't always signal a big macro story. Sometimes they're just the mechanics of the calendar. We'll be unpacking all of this for you when the bell gets closed Monday morning in our pre-open segment, and then all week long as the tape tries to finish the year on its own terms. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.